So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Travis Watts. Travis is a full-time passive investor. He has been investing in real estate since 2009 in multifamily, single-family, and vacation rentals. Travis is also the Director of Investor Relations at Ashcroft Capital. He dedicates his time to educating others who are looking to be more hands-off in real estate. Travis, welcome.
Jonathan, thanks so much for having me, man. Thrilled to be here.
Absolutely. Looking forward to it. Looking forward to educating the listeners on, being a full-time passive investor. Not too many people talk about that, but it is certainly something you can do. Some other big names come to mind. Jeremy Rolls, also a big name in that as well. But before we touch on all of that, let's kind of take it back to the beginning. We alluded there in the intro, you started back in 2009. What were you doing before that, and what led you to where you're at?
Sure. Happy to share that. I'll kind of put it in a story form for you. So my parents were very frugal minded folks, right? Using coupons and buying off brands and that kind of stuff. And I'm very grateful for that kind of upbringing, although that's, as you and I, and I'm sure your listeners are aware, that's not what gets you to ultimate wealth, and things like that. But it was just this epiphany I had at one point where all I was looking at as a kid was, I want to earn a high income, right? I just want to find a job. I want to make 10K a month, and then my life is great. But what I started to realize is in that example, everybody pays taxes, when you're W-2 or whatever, self-employed. And so you knock 3,000 off the top right there. And then a couple grand, you got to live somewhere. You got rent, you got mortgage, you got property tax, whatever it is. And then you've got insurance and food and, cell phones and miscellaneous. And so at the end of the day, out of that equation, I thought, even if I was really frugal and real good with my money and I was an avid saver, I may only have a potential to save about $3,000 per month. And so if you run that math, it's like, if you never increased your lifestyle and never started a family and never took vacations, and then one day you're 65, what kind of life is that? And you've got your $1 million, that's awesome. Good job if inflation didn't eat that away. And so you're very capped, living a very reduced life that way and ending up with that kind of outcome. And so it was a multitude of mentors and books, and of course the Rich Dad Poor Dad stuff and all that, where you start realizing, I think my fascination was really around compounding. I remember this study that was done, or this example, this theoretical thing of this 21-year-old putting a couple $100 away per month into this whatever, say you call it a brokerage account, right? And then they only do that for 10 years, approximately till age 30, and never touch it again, and virtually end up with the same end result, right? $1 million in their brokerage account, and not having to make those kinds of sacrifices past the age of 30. And I thought, wow, investing has such a larger potential, right? Because what's your cap on how much you can earn through investing or through running a business or something like that? It's literally unlimited, at least in our country, And so I thought, that's what I want to pursue. I really want to go down that path. So as you mentioned in my bio, it started with house hacking, which is just having a roommate. That was a big eye opener because, it was my first home I was living in, had a spare bedroom. It was near a college. I thought, hey, let me furnish it cheaply, through Craigslist and stuff. Let me rent it out for $600 per month because I know there's a big demand for that. And my mortgage was like $640 a month. So I'm living effectively for $40 per month. There goes a big overhead expense right off the bat when I'm not making a lot of money. So that inspired me to say, how can I get 100 of those checks for 600? How do I scale something like this? I don't want to go buy a mansion and rent 100 bedrooms out, but how can I do this? And long story short, led to multifamily investing in a more hands-off manner with other operators and learning about the power of diversifying and scaling and all of that. So kind of leads me through today. As you point out, I'm good friends with Jeremy Roll. There's numerous of us out there. Not a lot of people, though, publicly speaking about it, I guess. A lot of people are kind of behind the scenes, but yeah, man, all of my investments are hands off. So I'm not doing the active real estate anymore. And not to say anybody listening should be what I am or do what I do. I'm not here to promote that. I'm just saying for a lot of folks, being in real estate without having to be the landlord, so to speak, makes a lot of sense. And so happy to share any thoughts on that.
Absolutely. No, I love the story. You made a lot of really, really great points. So kind of talk about, obviously a lot of people actually love what they do, right? You think of someone like a doctor or even engineers, dentists, they love what they do. Maybe they own their own practice, so this is a really, really awesome strategy that they can use while they can still be professional and, generate that passive income and actually, build that wealth like you mentioned. So what are some things that you really pay attention to that help you, do your due diligence on an operator and ultimately decide if you want to invest in a deal?
Yeah, absolutely. First, I'll touch on what you just pointed out initially, and it's all about the individual and their goals and wants and needs. And the parallel I like to draw, because a lot of us are brought up thinking about investing as the stock market, right? There's nothing else outside of that bubble, so to speak. And so the parallel would be this: you could be a stock trader on a daily full-time basis. So that's the equivalent of like your house flipper in real estate, right? So a lot of people are turned off by the idea that I don't have time for that. That's a lot of work, blah, 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 whatever. And then you've got index funds, right? You can be a passive investor. You can just invest broadly in a diversified way and just say, I'm a doctor, I'm an engineer, whatever. I make good money and I just want to put some over there for, a later time. And that's what apartment syndications can be. That's what real estate private placements are, quite frankly, for a lot of people. It's just a portion of your portfolio that's hands off, where you get some awesome tax advantages, monthly cash flow, maybe quarterly, and then participate in any equity upside as you hold and go down the road. So I'll start with that. And then your question about, the way I look at investing now, the way I do it, my personal strategy, again, not telling anyone else what to do, it's just what I do, is I always start with my goals in mind first. So my 1 year, my 3 year, my 5 year, my 10 year, you can be as detailed as you want. Where are you trying to get and why are you trying to get there? I hear all the time, I want 10,000 a month cash flow, or I want $1 million in the bank. Or why do you want that? What are you going to do with it? If you had it right now today, no strings attached, why not 11K? You know what I mean? Why not 800K? Like, why $1 million? Why 10K? So you got to start getting detailed. And the more emotion you can put into your goals, the more it's based around, retiring my wife, putting my kids through college, whatever it is, right? Helping parents in retirement, the more you're willing to stay on the path. You know what I mean? If you just set out and aimlessly say $1 million in the bank, then we hit a hardcore recession down the road and you half your net worth, you might just give up and say, screw it. I don't need to be a millionaire. I'm good. At least I have a job. And so that's kind of the first step, right? Understand your goals. Then you need to get educated on the types of investments that exist. There's investments like put your money in the bank or a CD that's giving you like 1% a year. There's flipping homes, high risk, high reward kind of stuff, and trading stocks. There's crypto, there's development, there's cash flowing real estate. There's so much out there. So you're trying to figure out, for you specifically, what kind of investment vehicle can get you to the outcomes that you said you want to achieve, right? And so for me, that's always been a mix of cash flow to live on and equity upside potential to kind of further compound my net worth over time. And so for me, that's been value add apartment investing for the most part in these multifamily syndications. But I invest in other things too. That's just kind of my bread and butter and my go-to. So then, I'm getting to your answer, I promise.
No, this is great. I love it. This is mostly more what I wanted, honestly. So this is perfect.
Okay, cool. And so at this point, you're like, okay, let's say, just because that's a simple example, you want to do multifamily value add syndication investing. So now you're going to go find people doing that. You're going to look at, their track record, who they are, what their philosophy is. We talked before the show a little bit about, people invest with people, right? If I resonate 100% with your philosophy and your mindset, then I'm more willing to just invest with you as an operator for that reason, more so than, oh, it's a 1983 and it has a pitched roof and it's 8-foot ceiling, this kind of stuff. That becomes a lot lesser of a point. And it's kind of about the macro level. So you want to get on all the list of these folks. You want to have these conversations with operators. You want to get to know them. They need to know you and your goals and your criteria. And so this is the relationship side of this business. I launched a podcast called the Actively Passive Show, and it's the irony of the active components to being a passive investor. It's not as simple as just, I got 100K. I don't know who you are, but here's my money and go figure it out, please. It's that there's some active components that you need to do to learn risk and due diligence and vetting deals and operators and sponsors. And so I'm a pretty macro level guy when it comes to, say, markets. I'm looking at just nationwide stats. I'm looking at, why do I like certain markets over others, just from a high level. Who's moving there? Why are people moving there? What are the politics like? What are the taxes like? Just that kind of stuff, And then I'm letting the operators fill me in on the very specifics of like the sub market. I might understand Dallas, Fort Worth from a macro level. I don't necessarily know Richardson, Texas, and if that's a good market or not, And so I can't be an expert in everything. That's the beauty of being a hands-off passive investor. I let operators kind of do the heavy lifting, but I still want to trust but verify, so to speak. And so that's kind of my due diligence phase of it. And then, the part where everyone tends to get hung up is just taking action, not getting caught in analysis by paralysis, not saying I'm going to take the next 3 or 4 years to study this and then I might think about doing a deal. It's like, get educated as quick as you can, do your due diligence, ask your questions, and just try it. Go into one deal. This is what I did, by the way. I went into one deal in 2015, a bit skeptical, a bit naive, but I went in with a minimum investment. And I was like, if it's too good to be true, I'm going to figure it out in about 6 months or so. And thankfully, it wasn't too good to be true. It actually was legit. And that really opened the gate for me to saying, you know what? Forget all these single family properties I have and all this hands-on crap and being a landlord, quite frankly. I just want to do this. And so that's what I did. I went full-time active to full-time passive in about 18 months, give or take.
Wow. Love that. And you kind of mentioned it. It's kind of ironic because in order to be a good passive investor, there has to be an active component.
Yeah.
And certainly that's not to say that people don't just give $100,000 to someone who maybe, they're on their email list, but, if you want a sustainable strategy, certainly there is an active component. But now that you've been doing it for so long, what is kind of the maintenance to that strategy, right? Like, you're obviously not drilling down on your due diligence with every operator because like and trust them so far already. So what's kind of the maintenance that you do along the way?
Yeah, the way I've always kind of presented that or explained it to others is it's kind of a front-loaded business strategy, right? Because front-loaded that you have to get educated, you have to listen to podcasts like this one, you have to read some books, maybe find a mentor or two to help you out, maybe join a network or some kind of program if you feel like that's necessary for you. And so that's the most active, hopefully for you, that it's ever going to be, is just getting the foundation built and deciding what philosophy you subscribe to and getting clear on your goals and why you're trying to get there. Once you're there, to your point, what I did originally is that I didn't know what I didn't know, and I recognized that. And I went out when I was selling my single family homes, and I went and diversified with a lot of operators across the board with a bunch of minimum investments because I just didn't know who was going to be great and who was going to suck. And so now I've reeled that back in, and I'm doubling down on the groups that have underpromised and over-delivered throughout the years, And so to your point, I've already done my due diligence on these companies at this point. I've already seen deals go full cycle all the way through, have a return of capital, realize that that's a legit business practice and that they're good at it. Now I'm just doing more deals with them. And so there's no right or wrong answer to any of this. It's just that, and not to discourage anyone who's thinking, hey, I am a doctor or a physician or whatever I am, and I just want to diversify, not trying to paint the picture that you have to be very, very active or take years to educate yourself. I'm just saying, you don't want to be dumb with your money, right? I mean, you don't want to make a mistake where you're in this illiquid investment 5 years and you didn't realize what you were getting into, and now your money's locked up, So that's why I think conversations are the best method to learn. Get on the phone with an operator and just ask your questions. Say, I'm new to this. Here's my situation, what I'm trying to achieve. This seems like it might be a good thing for me. Maybe, I don't know, but just explain like what you do and how that works. And, how are you able to achieve these kinds of returns that you've done historically? Because whatever, I'm coming from the Wall Street side of things, and I'm used to looking at these 5% returns, and now you're saying you might get a 15 or something. Seems too good to be true, right? Just call them out on it and figure out how it works. And so that's the easiest, cheapest, most efficient way to learn, I think. It may start with a podcast like this, but it ends up always in a conversation with somebody else.
Absolutely. And this is a perfect segue. Now what you do as your active role is your, director of investor relations for Ashcroft, which is Joe Fairless's group. Obviously, household name in the industry. If you guys don't know who he is, definitely look him up. Extremely intelligent person, has a ton of education out there. So speaking of education and groups to join, shameless plug for Joe, not affiliated with him at all, but I know some very, very well-established operators who came out of his group and are doing very well. So, there's one right there you can join. But how does, being a full-time passive investor play into this role and help you in understanding and educating your new investors as they join?
Yeah, 100%. This is my macro level viewpoint on kind of why passive income. Years ago, I was in a W-2 job that I absolutely hated. I was working in the oil industry. I was always away from home and traveling. I worked overseas in the Middle East. I did a lot of things that, swinging hammers, 120-degree weather, and then coming to Wyoming where it's negative 30, in the winters. It was like the worst of everything, right? So my motivation was to not have to do that for the rest of my life, first and foremost. And it was passive income that allowed me to branch away from that job into other things that I enjoyed doing more, and so that's the whole point. Why did I partner up with Joe, so to speak, with Ashcroft? Well, because I'm passionate about what we're talking about right now. I wanted to get the word out in a much bigger way, right? My own pocket, my own funds, my own marketing stuff without anything to really sell didn't really make a lot of sense. I wanted to reach a wider audience. So I'm part of Joe's podcast. I speak at the best ever conferences he puts on. I'm helping to contribute to his new book that's going to come out, all these different things. So I can cast that net a lot wider. And I truly, genuinely enjoy what I do. And I love doing the research about the macroeconomics and sharing that with people and my strategy and philosophy and all this kind of stuff. So the point is, forget about me. I'm talking too much about me right now. Think about you. And my thing that I always think about is, and I still do this today, I do this all the time, make up a number for you in your head of passive income. How would your life change if you had, for example, purposes only, $20,000 a month in passive income? Some people might switch from full-time work to part-time work. Some people might just decide to retire early. Some people might use the added income to enhance their lifestyle and get that dream car, that second house, take more vacations. I don't know, spend more time with friends and family. Everybody's different, but I'll tell you, there was two things that really inspired me years and years ago. It was a true story by a nurse named Bronnie Ware. I think she was out in Australia, and she worked with terminally ill patients that were living their final days out in life. And she wrote this beautiful book about the top regrets of the dying. And the top two regrets were that I never spent enough time with friends and family, and I never pursued my dreams and aspirations. And this came from surveying a ton of people. And I thought, there's so much truth to that. So how can I and others get to a point where you have at least the choice to do those two things, if that's going to be the two top regrets of people dying? Again, I'm a macro level guy. I'm always trying to zoom out and, think about me on my deathbed and what my regrets might be. And so that kind of motivated me to not live the kind of life where you got to have more all the time, where it's, I got 1 million now, I need 2, I got 2, I need 6, I got 6, I need 12. And one day you're 70 and you're dead. And what was it all about? And so I don't know, that may be right for some people, but it's just not the way that I want to live.
Totally. Yeah, no, that's a really great insight. One thing, I think Russell Brunson actually just had a podcast about this, if you listen to him, and he talked about, people who are, sort of satisfied and feeling, like they have not complacent, but content is the word I'm looking for, and he was jealous of people who can feel content, because, it's hard, especially as entrepreneurs, to not just have that burning desire for more and more and more and more, and kind of finding that balance. It can be very difficult. And so I really like that perspective of, okay, what does that look like if you have this much, going back to what you said in the beginning, your why 10,000 a month, what would that do for you, and what does that look like? So as you're building this team, I'm not sure if you're directly involved with the investors, but what are some things that your team is doing in terms of, we haven't really drilled into this on the podcast in terms of what investor relations actually looks like, especially at that level. Obviously Ashcroft has a large portfolio. So what does that look like, and what is your team doing in terms of, educating investors and helping them, reach their goals?
Sure. This year, my big push for our team, we've built out a pretty sizable team now of investor relations, is to get more video educational content out there. We do that in a multitude of ways, but I just started a multifamily investing 101 series. We've got Danielle on our team. She does 3 minutes of real estate. They're just these short snippets of, what is a cap rate? What is IRR, et cetera, that kind of stuff. I'm doing property tours visually now. I do them in person as well for anyone. I mean, I live in Central Florida. We own properties out here. And then we've got Texas-based people. We've got Atlanta-based folks. And so we're always encouraging, seeing is believing, right? Meeting our team and meeting our staff. It's very much a personal relationship business. I encourage everybody on my team to do Zoom calls if the client is open to it, because it's just more impactful to look somebody in the eyes, even virtually, and get the point, get to know them as a person, not just a phone call, not just an email specifically, So we're doing a lot of different things. I think the biggest thing to me in investor relations is to ask your clients, your investors, about their goals and about what they're trying to achieve. Again, what is their why? Like, why are they looking to partner, with Ashcroft in that example? And then to tie what we have available, if it makes any sense for them, to those goals, and say, you said that you're trying to save up this much money for, to college tuition, and you say you want this much cash flow to help you retire down the road. Well, we have this opportunity that has cash flow and has growth potential to it, right? And so kind of the combination of that could make sense for you. Of course, we never give financial advice or tell anybody what they should or shouldn't do, but it's just helping them kind of connect the dots, And quite frankly, sometimes, the products that we have aren't appropriate for somebody, in whatever situation. They're 90 years old and they need liquidity. Well, we're illiquid, and sometimes these deals can go 5-10 years out, and that may not make a lot of sense. Or they may be a non-accredited investor, and we unfortunately can't partner with non-accredited investors. So there's a multitude of things, but that's kind of the macro of it.
Awesome. I love that. So I do want to touch on, you kind of alluded to it here a couple of times, investing for cash flow and for appreciation. What are some ways that people can determine what the best option is for them between those two? And obviously, both kind of correlate as well, but, kind of separately, what are some ways people can look at those?
Sure. So let's use, again, just to reiterate, like a stock example, because so many people are familiar with that, and I'll relate it to real estate too in a minute. But so you look at, again, not financial advice, not telling anyone what to do, but I was just literally before our episode, I look at the markets and news headlines and things. And so I was fascinated by what's happened to Netflix as a stock here recently. And if you look back at, it was like December of 2017, the price is roughly the same today as what it was then, but it's been a hell of a roller coaster. And so the way a lot of people approach investing is, I'm going to dump some money in the stock. I think it's going to grow and do great over time. And it did, right? And then it had some dips, and then it did exceptionally well, and then some dips. And then, when COVID hit, it did amazing. And now it's all the way back to its starting price 5 years ago. And so if you needed that money today, you had a 0% return over 5 years because it doesn't distribute a dividend. It doesn't have any passive income to it, even though it's a household name, And so as compared to that in philosophy, you look at a different stock, like say an AT&T, and you go all the way back to 2006, it's trading for about the same price almost 15 years later. So you look at that chart and you think, what a crappy stock, right? It hadn't even changed in 15 years. But what you might fail to realize is that their dividend is quite high. It's been, 6, 7, 8% historically throughout those years. And so if you use the rule of 72, which is how long it takes your money to double, essentially, it's a simple calculation. You take 72 on a calculator, divide by your annualized percentage, whether that's from a bank or from a dividend or from cash flow on real estate, equals how many years to double your money. So let's just say AT&T, I don't know, I'm making this up, but say it's been a 6% yield over those 15 years, it would take you 12 years to double your money. And the cool thing about that is you would effectively have what I would, is probably not the right term to use, but kind of like an infinite return at this point, because you put in 100K, you receive more than 100K back through dividends, but you still hold the stock today and it's still paying about 6% a year. But then you've had all of that income to go put elsewhere, either to live on or to make other investments that further increase your cash flow. And I am just so in tune with that kind of philosophy to just snowball effect your passive income streams, and other people, of course, have talked about this a lot. Robert Kiyosaki is one of them. One of the things he used to say is, when I put money in a deal, the first thing I'm looking at is how soon do I get that money back? Because I want to redeploy it in something else, but I want to hold that asset too, in the meantime for the cash flow. And it's a beautiful concept. It's a bit theoretical, but at the same time, I've done it in my personal investments too. So it's not too far-fetched to think about things in these ways. And so that's the difference. In real estate, it's like the Netflix example is like the new construction project where you're going in today, you're speculating on things in the future. It may or may not pan out that way, who knows? And then the cash flow stabilized multifamily building is the AT&T example that's giving you at least a steady distribution every year, regardless of what happens to the price or the economy. And so to me, that's a beautiful thing. I don't know if that landed for your listeners, but that was a huge epiphany for me years ago to understand that.
No, that's incredible insight. Thank you so much for sharing that, and great examples that we can all kind of relate to, and kind of really understand, and hopefully this will help kind of shape their investment thesis so they can understand what they're really looking for. Of course, the 10,000 a month in passive income sounds great, but that may not be ultimately what fits your needs the best. So kind of along those lines, one last question I want to ask you before we get to our final questions here is there anyone who shouldn't be investing passively in real estate?
I would say, well, absolutely, as a short answer to that. And some examples would be let me put it to you this way. When I first got started in real estate around, it was 2009 in September, I didn't have a ton of capital to work with. And so had I just gone into something that paid me, 6% a year passive income, it just wouldn't have really made any impact in my life, right? I'd have enough passive income each month to, I don't know, pay a cell phone bill. And so while that's kind of cool, it's not that cool. And so it wouldn't have motivated me to stay on track, quite frankly. And so I went actively into these things that I'm talking about to build up the nest egg and to have a W-2 job that was good, high paying. And I was very frugal, like my parents had taught me, and I saved all my money and all this kind of stuff. And I put it into real estate and I started investing so I could grow that nest egg to the point that I could then transition into these passive investments on a full-time basis and have enough passive income to actually support my own lifestyle. And the simple math, just for example purposes only, is if you had a passive income investment, I don't care what it is in the whole world, and it gave you 8% a year, well, if you have $1 million, that's $80,000 per year. You know, we're pretty close to our example earlier of $10,000 a month in cash flow. So that's how the math works. But to start with $5K and something paying you 8% a year is just going to take an awful long time. So I say the folks that may not be hearing this message on the same wavelength, maybe someone that doesn't have a lot of capital, perhaps, that should focus maybe more on building that up first before you consider doing things like what I do.
Yeah, absolutely. Especially because, of course, you look back over history, and certainly real estate has, and I think Andrew Carnegie said, made the most, or 90% of millionaires came from real estate. And listen, and you can look back over history and it's pretty tried and true, but you also need to understand you can lose money, right?
Absolutely.
These are not guaranteed returns. Nothing is guaranteed in this.
Correct.
So you don't want to, your life savings of $50,000 into a deal, and then, the deal goes south or whatever it may be, and then it's all gone. So
100%.
Keep in mind, again, we don't give advice here. Speak to your legal counsel or CPA for all of that stuff. But yeah, so just something to kind of keep in mind. And I appreciate that, because certainly it's something to keep in mind, because there are other alternative outside of real estate that can be really, really great investments. Cool. So that brings us to the final 5. It's the last 5 questions I ask all of my guests. First question, what's the best advice you've gotten from a mentor?
Double down on what's working.
Love it. Simple and effective. What is it about your career that makes you feel like you're fulfilling your why?
I love helping people. I think that's ultimately where a lot of us humans get over time, is like, what's the most important thing? It turns out it's really not money, right? It's giving back to others. And I feel like I do that through giving my time back to others, where I never had that ability back when I worked in the oil industry and couldn't even be around my own family or friends, or even have an intimate relationship with someone, right? I was just always work. So yeah, giving back my time.
Awesome. I love it. Favorite non-real estate or investment related book?
Unleash the Power Within, Tony Robbins.
Nice. Awesome. If you could have any superpower, what would it be?
I've always said, so I love to read, and nowadays I do more audiobooks than physical books, but I always wish I could just put it on like a 20x speed and almost download that knowledge right to my brain in like an hour, and just say that, on to the next book, right? I think I could really, if you look at all these billionaires, you look at, Warren Buffett and Bill Gates and Elon, they all read like crazy, man. I mean, the average CEO reads like 12 or 15 books a year, something insane, compared to the average American that reads, I think, 1 book a year. So that's powerful. Absolutely. I know, like, speed reading or super reading, whatever you want to call it, would be huge, like in Limitless, where you can like half listen to a language and learn it, it'd be so great to absorb that. Awesome. And last one, what's the best way for people to get a hold of you and learn more? Sure. I created a little landing page. It's got a lot of resources on it. So it's ashcroftcapital.com/Travis. I have a calendar link where I do 15-minute calls. Doesn't have to be Ashcroft related. They're just about anything we talked about here. I've got downloadable resources and PDFs and things like that, some videos you can check out. So that's probably the best. I'm also on LinkedIn. A lot of people reach out there each week, Bigger Pockets, Facebook, Instagram. So I'm out there on social, always happy to connect and be a resource for anybody. Awesome. I love it. Travis, thank you so much for all of your insight. This has been really amazing. Thanks, Jonathan. Thanks everyone for tuning in. Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.